Welcome back to another video for HarborFinancialOnline.com. Today I'm going to be talking about capital gains tax requirements for filing and how to report a sale of an asset and what is considered an asset. So let me get the video going here, and I'm going to try to help you guys out with this area. So you'll report all capital gains on Schedule D, and Schedule D is attached to your Form 1040. This isn't a separate tax filing, this just gets attached to it. So it's just a document, a one-page document that's going to get attached to your regular 1040. You'll normally receive tax information from the sale of an asset from that institution that you made the sale to through. Like for example, stocks. That broker will send you a statement telling you how much you received from the sale of that asset. Normally they won't send you though what you paid for it, just the sale. So you're going to have to go to your records and see how much you paid for that asset, because you have to report the cost and the sale, and then the difference of those two can be your gain or your loss, is how it works. Stocks are the most common capital gains that you're going to report on your taxes. There's a lot of other items that are considered capital assets, but I would imagine most of you watching this video are watching it because you sold some stocks, and I'm going to try to help you with reporting these stocks. Now, the different capital gains tax rates are as followed. You have a 28% tax rate for any work, this is items sold, any work of art, rugs, antiques, gold, silver, gems, stamps, and any other items that are related to these. 28% for the gain on qualified stocks. This is for short-term stocks, stocks that you owned and sold in 1 year or less. It's going to be short-term. Long-term is going to be more than 1 year. You had that stock for more than 1 year, you'll be in the 15% tax bracket on the sale of these stocks. 25% for unrecaptured Section 1250 gains. Now, some people get confused on this. They think if I sold a stock and had a loss, I don't have to report it. You still have to report the loss of a stock. So make sure you're keeping all the records if you did have a loss on a stock. You can report up to $3,000 of losses per year, and this applies to stocks and other capital assets. If you had more than $3,000, that can be carried forward to the next tax year, or you could go back to your old tax returns and amend those and take that loss and offset any gains in the previous years. Schedule D, like I said, is the form that gets attached to your regular 1040 that details the cost of the asset and the sale of the asset. I'm going to take you to the form towards the end of this video and show you the details of this form. Now, selling a rental home or a vacation home is considered a sale of an asset, and you do have to report that. So you have to make sure that you're looking at, with rental homes, there's lots of rules that get specific to rental homes. So I would look a little bit further into that. You're still, basically what you're having to do is calculate the cost of these homes versus the sale and see if you had a profit or a loss on that home when selling it. Your main home, you normally don't have to report it. So let's go to the Schedule D real quick. Just 1 second. Okay, so this is the Schedule D form. This gets attached to your regular Form 1040. And in Part 1, you can see here, this is going to be the description of the property. So we'll just put XYZ stocks. The date acquired, we'll make up a date. Date sold, we'll make up another date. Now, if you're preparing the return online, it's automatically going to fill in this form, so you wouldn't have to do what I'm doing right now. The sales price, this is the total of all the stocks for that particular stock that you bought, the price, how much you received when you sold that stock. Now the cost, let's say we paid $1,000 for all those stocks. And here, I want to go here real quick. You have to put how many stocks you bought. So let's put 50. Okay. So that would translate, we had a sales price of $2,000, 50 stocks, so we're looking at $40 a share is what you sold it as. You bought it for a total of $1,000. That's going to mean you paid $20 a stock. So you doubled your money. So your gain is the difference between D and E. So now your gain is $1,000. This is all going to flow down, and when you do it online, it's going to calculate exactly what the tax is going to be and fill in these boxes. So based on that, what we have calculated right there, you're going to have a gain of $1,000. This is short term, 12 months or less. Down here, long term, identical information, but more than 1 year. And that's the form, the Schedule D. It's a fairly easy form, but I recommend doing it online if you can, just to eliminate the chances of making any errors. On our website, harborfinancialonline.com, we have a page solely devoted to capital gains tax law and the difference between short-term, long-term, the holding period, that's how long you had the stock for, that determines if it's short-term or long-term, the different rates, different brackets you're going to be in, capital losses, and how much of that capital loss can be deducted. So that's the main thing you need to know on capital gains tax reporting. I do have more videos that focus in on certain areas of capital gains you may want to check out. I appreciate you watching our video. Check out harborfinancialonline.com. Thank you.